budget is here, and in the first of our pre-budget series, we see the market asking 5 important questions. 1. Given the upcoming elections, will there be some populist announcements? 2. Will the capex thrust continue? 3. Will there be money for capex and freebies plus a cut in deficit? So what kind of a fiscal deficit cut will please the investors in bond markets? 4. Most important, can one hope for tax cuts for you and me, given the superb growth in income tax in the current year and the upcoming election? And finally, what is a legitimate tax growth assumption that the government can go with? For all this, I'm joined by 4 top-notch economists: Samiran Chakrabarty of Citi, Soumya Kanti Ghosh of State Bank, Kaushik of Deutsche Bank, and Latha of NIPFP. Gentlemen and Kavita, thank you very much for joining in. Samiran, to you first. First, this populist question is what the investors will wonder with the election coming up. What kind of big bang announcements could be there on the populist front?
Thanks, Latha, for having me. I guess in a pre-election year, that expectation is an obvious expectation from the market side. But we have to also understand that traditionally, interim budgets have not announced too many completely new schemes, barring the 2019 one where the PM Kisan scheme was announced. By our estimate, if the government has to meet both the targets of reducing the fiscal deficit by a substantial amount and keep the capex focus intact, then the scope for further increase in the populist schemes is relatively limited. The political backdrop is also such that the pressure on doing such appears to be also limited. But some of the small tweaks can always be done, like we have estimated that if the PM Kisan scheme amount is increased from 6,000 rupees to 9,000 rupees, the additional burden on the exchequer is only about 0.1% of GDP. So those kind of small changes can happen, but don't expect a big bang populist scheme. In fact, in our estimate, revenue expenditure as a proportion of GDP should be falling this year compared to last year.
Oh, should be falling. That's interesting. Soumya, would you go with that? No populist announcements needed because the political tailwind is with the current government, so no compulsions. I mean, we shouldn't expect, most important, every one of us would be expecting any limited tax giveaways, at least for the lowest bracket.
Yeah, thank you, Latha, for having me on the show. No, I think I largely concur with Samiran, but there are a little small bits of ifs and buts. I think, yes, the pressure on political dispensation is significantly lower. So from that point of view, the interim budget may not have significant announcements. But my sense is that there could be some sort of an announcements or a roadmap for a larger overall picture in the next couple of years in terms of some of the programs which the government is likely to envisage. For example, the focus could be on one of the most discussed programs of the government, the Prime Minister Awas Yojana. So there could be some announcements or some roadmap on how the government is going to increase the allocation to that sector. And also
with tax cuts, you think, for Awas, for housing?
I think tax cuts should not be for the overall segment of the population, because the government is very keen that we migrate to the new tax regime where exemptions are few and far between. So if any tax exemptions come, that should come with an attachment that you migrate to the new tax regime.
Okay. No, so I'm very much interested to first answer, since all of us are taxpayers, those who are going to listen to this program as well. That's why I'm just wanting to clear that first. Any expectations, Kaushik, in terms of, mutual funds, any expectation at all on the tax front, either as investors, home buyers, or just pure taxpayers?
Latha, thank you for having me on the show. It would be nice if we get it, but I doubt whether in the interim budget we would get such an announcement, because it's an interim budget. Maybe in the first week of July, when the new budget is presented, we could have some changes. At that point of time, this debate could be much more relevant. But at this time, I think, they will stick to the broad fiscal deficit, consolidation plan that we have in mind, coming down to 5.3, that kind of a number. But also remember that Prime Minister Modi already announced free food program for the next 5 years. So that has already been announced, and a lot of things have been announced even before the budget. So I don't expect something which would look hugely, populist, and they've been good in managing the fiscal deficit before elections.
No, time permitting, I'm going to come back to this question and to Soumya's Awas question as well. There is also the fuel tax cut that many people are expecting. But let me come to the big number with you, Kavita. Can the government assume a very good tax buoyancy? I mean, this time the income tax growth has been for the first 8-9 months over 30%. So even the overall tax buoyancy is what, 1.4 or thereabouts? By which we mean for 100 rupees of GDP, you're getting 114% rise in taxes. Kavita, can one go with a high tax buoyancy? What would your forecast be?
My sense is we wouldn't be looking at a high buoyancy being built into the budget. I think part of the high buoyancy seems to be coming from compliance and administrative measures, which means it's like a one-time step up. So I wouldn't expect to see it penciled in the budget. I think in the last few years, we have seen that governments are happy to pencil in a lower number and get any upsides from tax surprises rather than factoring them in upfront.
Okay, that's a good one. Samiran, your reaction to that, what kind of tax growth will you go with? And more importantly, I read your report. You're expecting a very good non-tax growth?
So, Latha, if you see the tax to GDP ratio for the central government has already reached very close to an all-time high, despite corporate tax rates being cut, despite GST rates being lower than pre-GST, excise duty, etc. So that shows that the effect of compliance is already feeding into the process. So in our estimate, generally, as Kavita was mentioning, that we understand that the government is conservative at the beginning of the year. So we also typically take the tax buoyancy to be 1. But this year, we have taken it to be slightly higher at 1.1, accepting that there is a compliance effect that the government is going to acknowledge. But the non-tax revenue is the one which is going to be the real surprise, according to us. In our sense, the RBI dividend could be significantly higher this year. We don't know to what extent the government will put it in the interim budget, but by the time the final budget will be presented, the government will have a very good idea about it. And also the PSU profitability has continued in FY24 as well. So maybe the government extrapolates that for FY25, and that gives the boost to the non-tax revenue part of it.
Okay, so right now what you all have said is there's a possibility of more money going to PMGKY, and all the FMCG companies and those kinds of shares will be very attentive on that suggestion. But what about CapEx? Extraordinarily good, what, 35% higher CapEx this year, and almost delivered in the first 9 months at least. Soumya, what's your sense? Can they persist with this kind of, 3.2% of GDP as the CapEx number this year as well? I mean, FY25 as well?
Yeah, I think, Latha, on the CapEx front, I believe that the government is again going to get a positive, give a positive surprise, because last year it was around, I think, 3.2% of GDP.
Yeah.
And I will not be surprised if the growth continues to be in double digits. We are penciling in a growth of around 13 to 14%, which means it could be close to 3.5% of GDP in the next fiscal. Remember the point that Samiran mentioned, that there has been a significant buoyancy in the non-tax revenue. So what has happened in the government kitty is that there is now a shift from disinvestment receipts to the non-tax revenue, in the sense that the profitability of all the public sector companies that are highest levels. And if you look into the market capitalization, other of the CPSE and the financial institutions, which could be monetized by the government by selling of the stake, is now at more than 50 trillion. So given the fact that this will also have a multiplier effect on the monetization of assets, which the government is planning to do in the next 1 or 2 years. So if I take all these factors into consideration, I think all these factors, CapEx, monetization of assets, they go together. So I'll not be surprised if the government continues to have a steadfast resolve on capital expenditure. maybe the growth could be not as much high as last year, but at least a growth of around 13 to 14% is given in the current circumstances. So it could be close to 3.4 to 3.5% of GDP next year against 3.2% this year.
Okay, so all those who have betted on all the government capex stocks, railway stocks, will have their ears up at what you and Samiran are saying. Kaushik, divestment has been a rather poor record. In spite of very muted forecasts for the current year, they are not achieving. You think that will be a pillar that we should watch out for in the budget?
So there are two things, Latha. One is what will be shown in the budget as budget estimate. So over there, I think they'll again show 50,000 crore or 65,000 crore as the budget estimate. This year, we are probably going to make only 10,000 crore and much lower than what was expected. So that doesn't mean the next year will not have a big amount. It'll be, not obviously 1 trillion or something, but close to 50,000, 65,000 crore. And often what happens is that these things require a lot of time to get, clearances. And some year you could be lucky and you could get bunched up divestments happening if markets are doing well. So maybe FY25 we could be lucky and getting the money that we did not get in the previous few years. So that way it could be a positive upside surprise. But I think they'll show around 50,000 to 65,000 crore. On the capital expenditure side, I agree with Soumya that we probably would get a number of 11 trillion INR for next year. And that would be about 3.4% of GDP and about 15-16% year-on-year growth compared to 35-36% that was estimated for this year. But that what it does is with revenue expenditure coming down, as Samiran was mentioning, the revenue deficit to fiscal deficit ratio, which is the quality of fiscal consolidation, that is going to be probably at a record low. And the lower the ratio, the better the quality of fiscal consolidation. So I think government continues with the thrust on capex, hoping that the private sector capex also increases in a broad-based manner after elections. But only one point I'd like to make, that this budget will be presented in the first week of July. By that time, April, June is already behind us. So you have to spend all that money in 9 months, what is remaining in the fiscal year. So I don't think it will go beyond 11 trillion, which itself would be 15-16% growth over the previous year.
But let me tell you, our poll threw up a number of 11.25 trillion. And Samiran here is expecting almost 12 trillion. I haven't done the math, but I think he's expecting 3.6% of the nominal GDP. If you take a GDP of 330 trillion, it comes to 11.9 trillion for me. But Kavita, the big question, fiscal deficit. Will they promise, something closer to 5.2? What are you going with, and what's a number that the market will like?
My sense is that anything between 5.2 and 5.4, it creates 5.4 creates a little more space for the government to be seen to be doing things in the revenue expenditure side, which I think governments will be a little uncomfortable in the budget year to be showing a decline in revenue expenditure. So my sense is for the interim budget, things may not look as robust as Samiran is expecting. I would think perhaps slightly lower capex, but maybe a 2%, 3% increase in revenue expenditure is what I would look at.
No,
and a deficit of 5.3 odd.
Okay, 5.3 is your number. Let me take a quick poll. Samiran, you're 5.5, right? Okay,
that's right.
I'll look for your defense after the break. Soumya, you're going with what?
Yeah, I'm also going with 5.5. I have an argument for that.
5.5, okay. I'll take your arguments. Kaushik, you're going with?
We are going with 5.3.
Okay, 5.3 is our poll, and Kavita and Kaushik are on that number. But two stalwarts, Samiran and Soumya, are on 5.5. After the break, we will ask how the government will get away with the 5.5 when their forecast or when their goal is 4.5 in just one more fiscal year, and many more questions. Back in a minute. Welcome back. We are doing first of our pre-budget shows with four stalwart economists, Samiran Chakrabarty of Citi, Soumya Ghosh of SBI, Kavita Rao of NIPFP and Kaushik Das of Deutsche Bank. Gentlemen, and Kavita, thank you very much for your patience. Before going to the break, we took a poll on the fiscal deficit. Soumya and Samiran are expecting a 5.5% fiscal deficit in the forthcoming year in FY25. Kavita and Kaushik are standing at 5.3, which is the CNBC-TV18 poll as well. Samiran, to you first, wouldn't a 5.5 disappoint the market? Already, India is an outlier among emerging markets with a very high debt to GDP ratio. And the government's stated goal is 4.5 in one more year. So, should they not come to 5.2, 5.3 in 25?
So, Latha, let's be practical here. Historically, we have not been very good at meeting the FRBM targets. We have always kind of kicked the can down the road a bit on FRBM with any kind of shock. So my sense is that this is a very peculiar year where funding the fiscal deficit is unlikely to be a problem because of global bond index inclusion. We're going to get some $20–25 billion of extra demand for bonds. In that kind of a year, to have a marginally higher fiscal deficit might not be that big a challenge. And this government has always been very good at presenting credible fiscal numbers. So if they want to keep the capex focus intact and the fact that it's a pre-election year where deep revenue expenditure cut is difficult, then if you want to make it credible, the fiscal numbers, then maybe a tad higher number is a better option. Even if you meet that 4.5% of GDP by FY27, sky is not going to fall. So I guess that's not something which will push the government into necessarily announcing a number which is exactly in line with that drop.
Take your point that at the moment there is a big buyer standing with $25 billion in the bag. Soumya, is that the reason why you also think it's 5.5? They will be able to get away because of a hungry market?
Latha, I think there is also one aspect I would like to add to Samiran's point is that if you look into the interim budget fiscal deficit numbers and the budgeted fiscal deficit numbers from 2004 onwards, you will find that there has been a little difference between the two. Okay. If I take the example of 2019, I think the figures were kept 10 basis points higher. It came down 10 basis points lower, and that was because of a revision in the nominal GDP. Yeah. My sense is that they will keep it at 5.5%, but there is every possibility that number will actually decline because of the statistical artifact of a higher GDP numbers when the numbers were released in May, on the last week of May. So that will already give a cushion to government of around 10 basis points of a reduction in fiscal deficit when the numbers are announced in the budget. So my point is that when they're getting a cushion of 10 basis points already because of an anticipated higher GDP growth rate, the projections are yet to come, which will come in February, then why experiment with a lower fiscal deficit number? And this government has always under-promised and over-delivered in terms of the fiscal deficit numbers. If you look into the actual fiscal deficit number of 9.2%, 9.2 was in COVID year, even if it comes down to 5.5, there's some consolidation of 370 basis points. And given the fact that government expenditure this year, if you look to the ministries, the expenditure of the different ministries, it is already around 60 to 65%, and that has been the norm. So an automatic stabilizer has been built into the budget of expenditure saving. And that, I think, is also going to play out in the next year. So I don't see any harm if the government keeps it at 5.5%. Let the number drift towards 5.4 in the July budget because of statistical reason, and then take a call on how to move forward.
That is quite possible that they revise the number in the July budget because it's possible that the base may change because they have not been able to spend on capex in the last 3 months or 4 months. In fact, we saw a poor capex even in October, November, didn't we? So Kaushik, very quickly, your numbers for both the current year fiscal, will it be 5.9 and 5.3? What will you go with?
So 5.9, I think, will be achieved this year, irrespective of elections. And that was very clear even 6 months back. So I've given in my report all the numbers, how it will be achieved, the upside, downside in different components. But I don't agree with the reasons which Samiran and Soumya talked about. I think it's very important that you stick to the fiscal consolidation agenda and you reach 4.5 in FY26, because you are getting bond index inclusion done, and maybe more index inclusion will happen. You need to show that you are serious about hitting that 4.5%, and it's always easier if you are at 5.3 this year and another 75 basis points consolidation next year.
Okay.
Remember that India's debt GDP, public sector debt GDP, is already above 80%, despite all the improvement that has happened in the last few years.
Okay.
And if you take the consolidated fiscal deficit with states, it's more than 8%, right? It's still very high. So when you're getting an opportunity, you never know what can hit you 1 year down the line. Your debt GDP can again go up from 80 to 90.
Yeah.
So when you're getting the opportunity, things are good. Try to do the reduction, and I think it's easily possible to show 5.3. Just one point, Latha, I would like to make for markets. What is important is not 5.3 or 5.5. It's what the kind of market borrowings that is expected, both on net market borrowings and gross market borrowings. So gross market borrowings were about 15.4 trillion in this year. If it is around the same number or a little lower, that is around expected lines. But if it is 16 trillion or higher, markets will sell off irrespective of the fiscal deficit number.
What's your net number?
Should be around 11. It should be around. So if it is 15.4, it should be around 11.2, 11.3. It should be lower than last year, is what my calculations are. And see, there are these complications of switches that the government will announce when they announce the revised estimate.
Yeah. Actually, we can't do that. Kaushik, we can't get into it because we're out of time. But I take your point. Our poll threw up 12 trillion, and I think Soumya and Samiran are around that figure. Kavita, absolutely out of time. But what is a decent nominal GDP number that the government should go with?
The advanced estimates have thrown a googly at all our anticipations, because the nominal GDP seems to be much lower than the budgeted number.
Yep.
I would think a 10.5, 11 is what I'd look at.
11 was our poll as well.
Yeah.
For viewers, that the nominal GDP becomes important because the fiscal deficit is a percentage of the nominal GDP. So what do you assume by way of real growth and inflation is what we want to know. Soumya, your real GDP, your nominal number?
I think it should be at least 11%, because the RBI has already said on record that the next year growth could be close to 7%.
Absolutely.
And CSP is still higher than RBI.
Yeah, and the wholesale price index was negative all of this year.
Yes.
So maybe we will have a positive wholesale inflation. Your nominal GDP number, Samiran?
I think 10.5 to 11 is where the government will probably pay.
Kaushik, you too? 10.5 to 11?
11%, yeah.
Okay, if it is 11, then I think the government will have elbow room. I think we have more or less the big budget numbers in place. Let's see how the actual budget or the vote on account measures up. Samiran, Soumya, Kavita and Kaushik, thank you very much for joining us in the first of our pre-budget macro numbers. That's it on this edition. There's more lined up for you after the break.